We apologize for that delay, just a bit of technicalities backstage there. But welcome to 25 minutes of giving you updates from the world of business. And here's what we've prepared for you. Global food prices set to surge, of course, following what's happening at the Strait of Hormuz. And then it's not good news in Egypt. Currency slumps to a 10-year low. And in Ghana, it's good news right there. Inflation eases a bit. Welcome to the program. I'm Ini John McCrath. This is Business Incorporated. We start from the global oil space. Prices urged high on Friday. Further concerns surrounding the reopening of the Strait of Hormuz and potential Iranian bans and fines on vessels. And it seems hostile for and also in violation of proposed rules. So we see oil futures settled more than $3 barrel higher at the close of trade yesterday. So for now, we see a 0.28% increase on, that's for WTI, $77.51 a barrel. Brent has also gained 0.32%, and it's gone up from $79 that we had yesterday to $82.77. Natural gas follows suit, 0.30% up, $2.64 a barrel. Iran is seeking fees of between 5% and 7% of the price of cargoes from ships using the strait. This is according to a senior Iranian official. Oman, meanwhile, is discussing fees of about 3%, while Washington wants no fees at all. While this week's signals on a potential deal have driven a roller coaster ride in market sentiment, the market remains in the dark as to what needs to happen for the agreement to be clinched. And this, of course, leaves a lot of uncertainty in the air. Closely related to that, to see what's happening with metals prices. That's for gold, firm today and en route to their biggest weekly gain since January, helped by weaker oil prices. Investors are waiting that non-farm payrolls from the United States, that should give a clue to interest rate outlook. So we see right there for spot gold. Spot gold is about 1.5% up at this time, while we see a huge 4.84% up for spot silver, and then platinum is also up 2.65%. Palladium also up. Just copper. Copper is the only metal for now that has not gained. The U.S. president told reporters that he believed that the war with Iran would be over soon, and said that the armed forces were experiencing issues with supplies of weapons. Crude oil prices, of course, we have already told you about that. And all of this is affecting global food prices. We see that has climbed to the highest level in 3 years on supply concerns, push up the cost of key commodities. The latest Food and Agriculture Organization Food Price Index shows higher prices for cereals, vegetable oils, dairy products, and sugar, driven by weather-related disruptions and, of course, the tightening global oil supply and global supplies. Annually, analysts say that adverse weather in major producing regions, export uncertainties, and stronger import demand are adding pressure to global food markets. The rising costs are raising concerns about food inflation, particularly in developing economies that rely heavily on imports. And economists are warning that sustained increases in food prices could complicate efforts by central banks to contain inflation, while placing additional pressure on household budgets. Markets are now watching for global harvests and trade flows for signs of easing supply constraints. And South Africa has signed a $500 million loan agreement with the Asian Infrastructure Investment, marking another step in its drive to finance critical infrastructure and support economic reforms. The agreement strengthens the country's partnership with the Beijing-based multilateral lender and is expected to help fund priority development projects. The financing comes as Pretoria seeks to boost investment in infrastructure, improve public services, and stimulate economic growth amid fiscal pressures. The loan is expected to complement the government's broader strategy of attracting development finance while maintaining macroeconomic stability. Malawi Central Bank left its policy rate unchanged at 24%, saying the current level is appropriate to keep inflation on a downward trajectory, though it is still well above the target. Policymakers say inflation is easing but remains above target, prompting a cautious approach to any policy changes. The decision aims to maintain price stability while supporting the country's economic recovery. And the central bank says it will continue to closely monitor inflation trends, exchange rate development, and global economic conditions before considering any adjustment to borrowing costs. In West Africa, Ghana's annual inflation rate that has eased to 4.6% in July from 5.3%. That's what it was in June, and this marks the first decline since March. The latest figures from the Ghana Statistical Service suggest that price pressures are beginning to moderate after 3 consecutive monthly increases. The slowdown is driven by softer increases in the prices of both food and non-food items, reinforcing expectations that inflation remains under control despite recent global economic uncertainties. And in Egypt, not good news coming from there. The pound there has recorded the steepest currency decline among Africa's largest economies over the past decade, and highlighting the country's prolonged struggle with foreign exchange shortages, inflation, and repeated currency devaluations. Analysts say depreciation reflects years of economic reforms and external financing pressures. The currency has weakened significantly against the US dollar since 2016, following multiple rounds of devaluation linked to International Monetary Fund-backed reforms aimed at restoring macroeconomic stability. While the moves have helped to attract foreign financing, they've also increased import costs and fueled inflation. Economists say recent improvements in foreign investment and foreign exchange availability are helping to stabilize the market, but maintaining investor confidence and sustaining economic reforms remain critical to strengthening the Egyptian pound over the long term. Africa's leading infrastructure guarantees platform plans to double its capital base as it steps up efforts to attract more private investment into infrastructure projects across the continent. The expansion is aimed at strengthening its capacity to provide risk guarantees that make large-scale projects more attractive to investors. The platform says increasing its capital will allow it to support more projects in sectors including energy, transport, digital infrastructure, and trade. By reducing investment risks, the guarantees are expected to unlock billions of dollars in private financing and help bridge Africa's infrastructure funding gap. And development finance institutions say guarantees are becoming an increasingly important tool as governments face tighter budgets and declining development aid. And so the move is expected to improve access to long-term financing and accelerate infrastructure development across the continent. And looking at the market at intraday, we see for Africa, stocks are mostly positive at intraday, including, of course, what's going on in Nigeria. And still talking about the market, let's go to the fixed income market. We spoke about an interesting story earlier today during business morning. There you have it, the NGX is positive. But let's go to the fixed income market, where the CBN and the DMO have suspended T-bills auction amid 4.69 trillion naira OMO sale auction. And what does that mean? Is it that demand has become really high? Because last week we did hear from the DMO that they reduced rates because of an increase in demand. So is this another strategy by the government to drive demand higher? Because of course when there seems to be scarcity, then most likely there'll be higher demand. But I wonder if that's what the DMO is working on. So we hear that they have suspended the sale of T-bills for this week. But I've been told by some analysts that this is not exactly a new thing or a big deal, because yes, they do have 2 auctions in a month. So even this is suspended, then we might have another one next week. But we know that the demand has been increasing for government securities over time, the last couple of time. And so amid this 4.69 trillion almost sale, which they have done, they have suspended further sale of T-bills. Is this a way to also manage government debt? Perhaps that will be something else. Now let's go to the Middle East and see what the market looks like. Well, stocks traded mostly negative at intraday, talking about the Middle East. And then in the United States, we saw stock features mixed in early trade. Traders are waiting the release of that jobs report, which I mentioned earlier. That's what investors are looking at. Airbnb shares for the United States, that's rallied over 8% in pre-market trading. And then also after the vacation rental company posted a bit on the top and bottom lines. Cloudflare also surged 16% in pre-market after the cloud cybersecurity company issued a solid full year and current quarter outlook. And going to Asia now, market close there, obviously time difference. We saw Japan's Nikkei 225 close 0.1%. 1.2% lower, 65,606.71. South Korea's Kospi was also down 0.6% at 6,258.77. That was described as a choppy trade. In Hong Kong, that was up 0.44% in the last hour of trade, while mainland China CSI, that closed 0.93% higher at 4,694. Market sentiment was supported by China's export growth in July, and that beats analyst estimates and, of course, excited the investors in the market. Let's see if we could get a fixed income analyst, Caleb Alimi, to join us now to comment on here in Nigeria the suspension of the T-bills auction by the CBN and the DMO. Caleb Alimi is the chief dealer, Providus Unity Bank. Hi, Mr. Alimi. Good afternoon. Welcome to the program.
Good afternoon, Ini. Thank you for having me.
Great. So this suspension of the T-bills auction, what does it mean? What does it signal? What are the regulators trying to achieve with this?
Okay, first of all, let's look at the communique that always comes out from the Debt Management Office of the Central Bank. They often say that their circulars or their calendars are subject to change. And former practice has always been that for Nigerian Treasury bills, you'd have standard 2 auctions in a month. So even on the calendar issuing and then letting us know that for this quarter, that there would have been 3 auctions per month was sort of like an anomaly. That signal to the market increased supply. So for them to have then suspended the auction that should have happened this week, and then it just follows into, so it just looks like they're going back to status quo. Indeed, the market is interpreted as sort of like a reduced supply, but we believe that the next auction demand is also still going to be sustained and it still affords the DM the opportunity to as much as they can or raise as much money as they want to. We may also want to look at what has happened over the last 3 auctions in the month of July, where demand consistently grew. In the first auction on the 8th of July, there was about subscription for the 1-year paper of around 1.8 trillion, but the DMO sold in 935 billion. And then by the next auction on the 15th of July, demand was about 2.8 trillion, and they sold just over 1 trillion. And then the last one on the 29th of July, demand was over 3 trillion. So there's appetite for government securities, especially on the 1-year paper. And so it could also be that, so we could look at it from 2 ways. Number one is the fact that the suspension of the auction that should have happened this week, could be a reset from the regulator or from the issuer. However, I think more of the fact that it is just status quo, just returning to the 2 auctions, 2 standard auctions every month. They're still able to, raise the amount of money they desire at those auctions.
So, because there's also the conversation that is this creating an artificial scarcity, to kind of give the regulators or the issuer an opportunity, more opportunity to reduce rates, because we did hear that they had plans to reduce rates amidst the heightened or increased demand?
That could be, but the demand already tells a story for itself. From the data that I just gave, from the 8th of July to 15th of July to 29th of July, you find that the stop rate have been dropping consistently. From the first 28th of July, 17.7% was where the one year stop rate closed. On 15th of July, it closed at 17.66. And on the 29th of July, it closed at 17.35 on the back of the fact that demand increased at every point in time. So it could serve them that, if they pull back a bit, rates will drop, further down. In the secondary market, those bonds or those bills are already trading around 17.10, 17.10%. So yes, there is sustained demand for these securities. And if they shift the auction to next week, I still think they would raise whatever they want to raise and rates will continue to drop.
So rates will continue to drop. Does it drive markets to the equities?
Yeah, it could, but again, it's capital allocation. Some capital must come to the fixed income market, and given how the equities market has done already in the course of the year, what are the chances that it's going to even do much better? I think it's about 60% year to date. Do you expect it to reach 100%? Maybe not quite. Some people will be taking profit around this time, especially given that this is dividend season, so we could see a lot more capital still flow into the fixed income market.
Think that even the Dangote IPO can attract investors from the fixed income to the equities?
Oh, I think that's the bride of the year. That's what everybody's waiting for. We'll see a lot of interest in that space, and the year will probably quote and unquote close from there. So there'll be capital waiting. A lot of people are okay. That's another reason why people could even put money in fixed income or in short-term money market instruments, just keeping their gunpowder dry for the Dangote offer.
Well, Mr. Alimi, do you see any disruptions from political spending, political activities? Do you see any disruption to the markets?
So typically in a pre-election year, what we've always found or what we know is the trend that we've seen is rates are elevated in pre-election years. That's because government borrowing and spending is always elevated. And if we look at the trend this year, it hasn't bucked that trend. The fact that we're still trading at 17 levels or the government is borrowing money at 17 levels for the 1 year paper, tells that story that debt is, they'll continue to borrow. So we think, we don't see a significant drop in those interests. We're not going to drop to a 15% handle between now and the end of the year because the government still has to borrow and they have to, fund the election. That's just the trend we've seen. So we don't expect any drastic drop. All this one are just what we call moderations, the market just moderating and, amidst excess liquidity in the system.
All right, Mr. Caleb Alimi, Chief Dealer at Providus Unity Bank, thank you so much for your time.
Thank you, Ini.
We're still staying in the markets now, but now we head to Europe, and Lars Holter joins us to give us our sentiments from the markets over there. Hey, Lars, good afternoon. Welcome to the program.
Hi, it's good to be with you. And I can tell you I got some good news here when it comes to markets because we're really green across the board. The DAX in Frankfurt remains in record territory and is the strongest performer here on the continent, up almost 1% by now. And the other main markets here, London, Paris, Madrid, all up only fractions, but they are in the green. That's what matters, especially today, since the oil price is up a bit on latest developments. And for markets, it's definitely a good sign if they can withstand that. And the DAX, by the way, has a few good corporate numbers to feed on today, and that's why it's doing pretty good.
So AI has been a major driver of both the markets and other parts of the economy. And the current situation now, we've seen AI crash the market also, a lot of profit taking at some point. What's the situation now when we look through the lens of artificial intelligence?
Well, yeah, it's certainly been everywhere recently. AI has greatly influenced most parts of the industry, and of course, certainly media too, and even people's own personal transactions online. And not everyone is comfortable with these developments. And I would say that in Europe here, and most certainly in Germany, many people are cautious regarding this latest technology, and for several reasons, actually. On the one hand, of course, it's hard to know how exactly AI will change our lives, how it's going to impact politics, the economy, society in general. But on the other hand, it's also seen as a problem here that AI just needs huge amounts of data, that data centers are planned everywhere, that the demand for electricity is extremely high, for water, for cooling as well. And that's what a lot of people here are worried about. And that that is certainly a reason why the biggest firms in this sector are actually mostly investing elsewhere. If we're looking at the big ones here, Alphabet, Amazon, Meta, Microsoft, they're investing $750 billion in AI infrastructure this year alone, but almost all of it outside the EU, with Europe's share of global data center capacity likely shrinking from 13% now to about 10% by 2030.
Yeah, and unfortunately, I mean, the story is already that the economy is weakened. So what are more implications? What more implication could this bring to Europe and, Germany and all of you guys there?
Yeah, that's a question right on the surface. It certainly looks like we're missing out on something huge, but it turns out that's not entirely the case. As a matter of fact, parts of the lucrative business here generated by this AI boom does actually benefit companies here in Europe, because there's this immense demand for components, for cooling systems, for energy supplies, and much of this comes actually from European manufacturers. Siemens, for example, they're offering energy management for data centers. The company's spin-off Siemens Energy builds gas turbines and transmission technology, and we have energy provider RWE. They're building entire gas power plants for some of these US-based data centers. They're also experts in battery storage, renewables, or so. And then we have a company like construction giant Hochtief that is actually putting up the very buildings that house data centers in the US. There's a lot of smaller companies as well that are currently selling billions worth of goods and services to U.S. companies to equip these data centers.
So could Germany be a long-term winner of this AI boom? Does it look like it?
Yeah, it definitely looks like large parts of the German economy can actually benefit. But with any boom, of course, there's also the risk of a bust. And so it is with artificial intelligence and the data sector as well. We've already seen shares of some AI chip makers drop recently, mostly out of fear that some of the tech companies may have overextended themselves with their investments. However, for now, none of the German companies fear that the rapid business growth here that we're seeing in that sector might come to an end anytime soon. The CEO of energy provider RWE, for example, he just said that he believes that the US is actually just a bellwether here for the industry, and that electricity demand will accelerate in other markets as well. So for now, we're seeing a lot of optimism, and some companies, like I said, they're making good money on AI here, even if most of the data centers are not actually being built here.
All right. Well, I guess there has to be re-strategies and recouping and re-collaboration, Lars. But thank you so much for giving us the update.
Thank you, Ini. Have a nice weekend.
You too. And just before we take you to the crypto space, well, we just have the payroll, the jobs payroll, farm payroll from the United States. That's out, and well, unfortunately, it shows that the U.S. economy unexpectedly shed 23,000 jobs in July, and unemployment rate cooled slightly to 4.1% from 4.2%. Economists had anticipated a growth of 85,000 jobs, but of course, we now see that they lost more jobs, 23,000. So that is just out now. We know that markets have been waiting for it. So the U.S. market will most probably react to that, seeing that it's early hours of trading for the United States. And then on Monday, of course, we will get more reactions to this job shed in the United States. And of course, we would dwell on that on Monday to get some of the reactions from the United States. Now, let's see what's happening in the crypto space. We see that President Donald Trump's cryptocurrency holdings, they are coming under renewed ethical scrutiny, and lawmakers are debating the Clarity Act, a bill designed to establish a regulatory framework for digital assets in the United States. The legislation has become entangled in concerns over potential conflict of interest because of Trump's significant financial stake in crypto ventures. That's one story. Negotiators are considering ethics provision that could require senior public officials, including the president, to divest certain crypto-related interests or place them in a blind trust. And we know that President Trump and his family members are very well in the crypto space. So we'll see what comes out of that. Also, July has become the second worst month of 2026 for cryptocurrency theft after hackers stole an estimated $247.4 million, and the attack spanned everything from hardware wallets to bridges to lending protocols and trading platforms. They were all affected in this. And then we moved to Russia, where Russia's Federal Security Service has raided several cryptocurrency exchange offices in Moscow as part of an investigation into alleged money laundering involving stolen funds. So those are the stories making the headlines from the crypto space, and that is where we draw the curtains on Business Incorporated today. Thank you so much for being a part of our week, and we hope to have a better week next week. But over the weekend, please go to our YouTube channel and watch our programs. Business Morning, Business Incorporated. It's good to stay informed. It affects your account and your pocket. But I'll see you tonight for the stock market report. I'm Ini John McCoy.